So Fed today cut the key interest rate by 25 basis points or 0.25%. I want to talk a little bit about the Federal Reserve, which is the central bank of the US, what its job and how it controls the money supply to keep the economy healthy. Okay, so one of the main ways the Fed does this is through monetary policy, which influences how much money is in the economy and how expensive it is to borrow money. So there's something called federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight. This rate affects how much it costs for everyone to borrow money, from businesses to regular people. And this is the interest rate, which is also called the key policy rate that you hear in the news. If the Fed wants to encourage spending and investment, it lowers the rate, which makes borrowing cheaper. If it wants to cool down the economy and control inflation, it raises the rate. Now there's something called discount window. So the discount window is where banks can borrow money directly from the Fed, usually at a higher interest rate than the federal funds rate. It's a backup option for banks that need quick cash but can't borrow from other banks. So the idea is to ensure banks always have enough money to operate and keep the economy stable. And there's something called reservation rate arbitrage. This term is more technical. It refers to the difference between the interest rate a bank can borrow money at the discount window, which is the reservation rate, and the rate they can get in the federal funds market. Banks might borrow from the discount window if the rate is cheaper than borrowing from other banks. But this happens less often because the Fed usually sets the federal funds rate lower than the discount window rate to keep things efficient. Now, what is open market operations? This is the Fed's main tool for controlling the money supply. It involves buying and selling US government bonds on the open market. When the Fed buys bonds, it puts more money into the economy, which encourages borrowing and spending. When it sells bond, it pulls the money out of the economy and helps slow down things if the inflation is too high. But this used to be the primary way the Fed managed the economy. But now we have something called ample reserve system and new monetary policy. In the ample reserve system, this is a newer approach. The Fed keeps plenty of money in the banking system to make sure banks always have enough cash on hand. Now, this reduces the need for the Fed to buy and sell bonds as much, which is what open market operations are all about. Instead, the Fed focuses more on setting the interest rate it pays banks for holding reserves with it. If the Fed wants to influence the economy, it changes this interest on reserves rate instead of using open market operations like before.